Hi everyone. If you've been following the T-bill yield, you'll probably be aware that the yields have been coming down over the past few months. If I were to look at the T-bill yield just about a year ago, it would have been above 3%. But in some of the recent auctions, we have seen it coming down to below 2.5%. In fact, in the most recent auction just about 2 weeks ago, we saw that the T-bill yield actually came down to 2.05%. So this led to many questions from many of our Telegram members around then what are some of the best places that we can park our cash and be earning a yield. In today's session, I'll just go through what we see in terms of the different products and what are the latest rates that they are offering. At Beansprout, we offer you the latest insights on Singapore stocks, bonds, REITs, and ETFs. We also have the latest fixed deposit, savings account, T-bill, as well as Singapore savings bond rates. What I'm going to do today is to look through our compilation of what are the latest rates for the month of June. I think what I will start with would be the fixed deposit rates, since this is something that many of our viewers are interested in. So for the fixed deposit, we have seen the rates continue to come down. We see here that the best 3-month fixed deposit rate is at 2.15%. The best 6-month fixed deposit rate is at 2.35%. The best 9-month fixed deposit rate is at 2.35%. And the best 1-year fixed deposit rate is at 2.45%. Okay, I think looking at this, naturally, many of us would be wondering whether there's any catch to the 1-year fixed deposit rate of 2.45% per annum, since that is significantly above the current T-bill yield. So I'll dive deeper to look at the best fixed deposit rates this month. And what we see here is that the best 12-month fixed deposit rate, the best 9-month fixed deposit rate, they are both offered by DBS or POSB. But it is important to note here that there is a maximum deposit amount of $19,999. Effectively, you need to put in an amount that is below 20,000, because once you get to 20,000, you'll be getting then a rate that is lower than the rate that is being shown here. Okay, next, if you were to come to the 6-month fixed deposit rate, we've got SBI that is offering the rate of 2.35% per annum. So once again, this is actually higher than what we see for the latest 6-month T-bill auction. What I see here is that the minimum amount is 50,000. So this might actually be a deterrence for some of us who are looking to put in an amount that is below 50,000. Then if I come to then look at some of the other rates that allow us to earn a yield that is above the T-bill yield, but don't require such a significant amount, then we have got DBS POSB with the 2.15% rate, but once again, this is capped at $19,999. We also have got ICBC at 2.1% per annum. And then we have got CIMB that's at 2.05% per annum. Okay, so those are the latest fixed deposit rates. What I've noticed is that the rates actually change very quickly. So sometimes some of our members will actually feedback that the rates have actually changed when they actually then try to apply for some of these fixed deposits. So it is best to always still check with the various banks as to the rates that they are offering, especially with the very volatile interest rate environment. Okay, next we'll look at the 6-month Singapore T-bill yield. Like I mentioned earlier, we have seen the fall in the 6-month T-bill yield over the previous auctions. So the latest auction on the 5th of June, we are looking at the cutoff yield at 2.05%. So this is lower than what we saw for the auction on the 22nd of May when it was at 2.2%. And if I were to look at just about 2 months ago, on the 10th of April, the rate was actually at 2.5%. So I think this is the trend that we have seen for the T-bill yield, where it's been coming down fairly consistently over the previous auctions. So if I were to look at, say, the recent high, just at the start of the year, it was still hovering at about 3%. In March this year, it was still at about 2.7%. But in the most recent auction, it is actually at 2.05%. Some of you might be wondering whether we might see a rebound in the upcoming auction. So we wrote something about that as well around the auction that's coming out on the 19th of June. And what we see here is that if I were to look at some of the latest rates in the market, the 10-year Singapore government bond yield continues to decline. And what we see in terms of the closing yield for the 6-month Singapore T-bill is at 2.04% as of 12th of June 2025. So effectively still very close to the 2.05% level that we saw for the cutoff yield in the previous auction. And if you're looking to apply for the T-bill using your CPF OA money, what is important to note is that based on the latest 6-month Singapore T-bill cutoff yield, it is below the break-even rate for CPF T-bill applications. So that is something that we need to be mindful about. Okay, so that is what we see for the T-bill yield, where the yield has been coming down in the previous auctions. So one of the questions that we have commonly received is, why is the T-bill yield coming down? Once again, going back to this chart of the T-bill yield, we saw the rate starting to come down from the second half of 2024. And just as a recap, that would be the period when the US Federal Reserve started cutting its interest rates. So they have cut the interest rates a couple of times in the second half of 2024. And while they have actually paused on some of the interest rate cuts in their recent meetings, there are expectations that the Fed will continue to cut interest rates again in the second half of 2025. So that is driving the decline in the T-bill yield that we see in the Singapore market. Next, we come to the savings account, and this is something that probably doesn't require much introduction, since most of us will have a savings account to park our emergency cash. Okay, so for what we see for the savings account is that there have been several cuts by the banks on the rates offered by their savings account. Just some of the key ones worth highlighting is that UOB One has cut the interest rates. We also see the interest rate cut by OCBC 360 as well. And from July onwards, we also have the interest rate for the UOB Stash account being cut. So overall, we see that the rates are coming down for savings account as well. One commonly asked question about this savings account is that each of them come with their own requirements that need to be met to be earning the interest rates. So then what are the different interest rates that I will be able to get based on these requirements that I'm able to fulfill? Okay, so we have actually summarized some of the best savings accounts here based on the different requirements that we are able to fulfill. And looking at the example, if I have $100,000 of savings, can credit my monthly salary into my savings account and spend regularly on my credit card, then one of the best savings account would be the OCBC 360 account, which offers an interest rate of up to 3.3% per annum for 100,000 of savings if I'm able to meet this criteria. If my savings actually go up higher to 150,000, then the UOB One account also offers an effective interest rate of up to 3.3% if I'm able to meet this criteria. What we often get as a feedback is that some of us may not be able to credit our salary. Some of us may not be spending so much on our credit cards. So then what are some of the other savings accounts to consider? So one of the savings account that is then commonly talked about is the UOB Stash account, which offers an effective interest rate of up to 3.0% if we have $100,000 of savings. The good thing about the UOB Stash account is that the requirements to meet are fairly limited. We just need to maintain a monthly average balance that is similar or above what we have in the previous month. But I think what is worth highlighting is that for the UOB Stash account, they will be cutting the interest rates as well. So with effect from 1st of July, their highest effective rate will actually be 2.045% per annum for deposits of 100,000. So what is attractive about the UOB Stash account is that you can stack it with another UOB promotion, the UOB Cash is King promotion that allows you to earn guaranteed cash when you put in fresh funds into your UOB account. Okay, so for example, if you top up 20,000 of new funds, you'll get a $50 cash credit. If you top up 50,000 of new funds, you'll get $150 of cash credit. And if you tap up 100,000 of new funds, you get $320 of cash credit. Okay, so effectively what this means is that that will add to the interest that you're getting on the UOB Stash account, and that makes the account more attractive compared to just looking at the base interest rate that we are receiving. Okay, there are various conditions that are required for the UOB Cash is King promotion, including things like the amount being earmarked. So if you want to find out more about this promotion, once again, you can come up to the Beansprout website to learn more about the promotion. Okay, coming back to the Best Savings account, some of you have shared that you want something that doesn't require you to jump through any hoops, not even requiring you to check whether you are able to maintain your monthly average balance. So I think if I were to look at some of the fast-free accounts in the market, then the GXS savings account is something that has been talked about. If I were to look at the GXS savings account, there are a few different tiers of interest rates that are being offered. For the savings pocket, that actually offers an interest rate of 1.98% per annum. Then they also have this thing that's called the Boost Pocket, which offers an interest rate of 2.08% per annum, but that is if you actually put your deposit there for 1 month or for a 3-month period. Okay, so what this actually means is that you'll be getting the base interest of 1.68%, but at the end of the 1 month or 3-month deposit, you'll be able to get the additional 0.4% per annum, and that effectively brings the interest rate on the Boost Pocket to 2.08% per annum. For the Boost Pocket, the maximum deposit for each of the Boost Pocket is 30,000. So you can open up to 2 Boost Pocket, which means that the total amount that you can potentially deposit into the Boost Pocket would be $60,000. Okay, what we have noticed is that GXS changes the interest rate on the Boost Pocket fairly frequently. Just at the start of this month, the GXS Boost Pocket was offering a rate of 2.28% per annum. So there's something that we will need to keep a lookout for to see whether they revise the rate for the Boost Pocket further from here. Okay, so I've introduced some of the different savings accounts in the market, whether you prefer something that allows you to earn a higher interest rate, but then requiring you to meet certain requirements, such as salary deposit or spending on the credit card, or if you prefer something that is relatively fast-free, you can go to the Beansprout website to find the best savings account in Singapore. So the good thing about savings account is that they are insured under the SDIC for deposits of up to $100,000. So that may actually provide some of you with a peace of mind when putting your money with some of these savings accounts. The other good thing about these savings accounts is that they provide us with liquidity in that we can take our money out anytime to meet some of our emergency uses. However, some of you have asked, oh, what if I want to be putting my money and earning an interest rate for a longer period of time? I want to lock in my interest rate for, say, up to 10 years. How can I actually do that? So there is another instrument that's called the Singapore Savings Bonds. Once again, like the T-bill, they are bonds that are issued by the Singapore government. So some of you may actually prefer to be able to lock in the interest rate for a longer period of time and have asked whether there's any instrument that allows us to be doing so. So this is where I wanted to introduce the Singapore Savings Bond, which is actually issued by the Singapore government and allows you to lock in an interest rate for up to 10 years. Okay, so this is effectively, so if you are familiar with the T-bill, this can also be the starting point for us to understand more about the Singapore Savings Bond or SSB. Okay, so for the T-bill that we are familiar with, the maturity is in 6 months or 12 months. For the Singapore Savings Bond, the maturity can actually be up to 10 years. What is interesting about the Singapore Savings Bond is that it effectively has a step-up interest rate. So effectively what we know about the Singapore Savings Bond is that the interest rate actually goes up the longer the period of time that you hold on to it. So for example, if I were to look at the latest issuance of the Singapore Savings Bond, the first year interest rate is at 2.06% per annum. The second year is also at 2.06% per annum, but by the fourth year, it actually goes up to an interest rate of 2.22% per annum. Okay, so what we see here is that there is a step-up interest rate, which means that the longer that you hold on to the Singapore Savings Bond, the higher the interest rate that you'll potentially get. So what we see here is that if you hold on to the Singapore Savings Bond for 1 year, you get an average return of 2.06%. If you hold on to the Singapore Savings Bond for 10 years, then you get an average return per year of 2.49%. Okay, so effectively, this is something that I would consider if I'm looking at an instrument that allows me to lock in the interest rate for a longer period of time, in this case, up to 10 years, because I'll be getting an interest rate of 2.49% on an annual basis. So the question that you might have is then, do I have to lock in my money for 10 years? And what if I actually decide to withdraw my money prior to the 10-year period? Okay, so the good thing about the Singapore Savings Bond is that you can actually withdraw prior to the 10-year maturity period. So you can actually withdraw your money in a month and the money will actually be paid back to you early next month. So that effectively still allows us to have the flexibility if you want to be taking out the money to be investing in other things. Or if you need the money for emergency users, we can also take out the money from the Singapore Savings Bond, just that it might actually take a bit longer compared to the savings account. Okay, so what I see here, 2.49%, which is above what we are having for the latest 6-month Singapore T-bill yield. Next, we often get questions around what are the other options to consider if you want to be earning a higher yield, but then also potentially taking on higher risk. So one other instrument that is often considered would then be cash management accounts. This cash management accounts would then be investing your money in different products. It can be by putting the money into banks and earning the deposit rate. It can be putting the money into short-term bond funds. And these are the different ways that it can actually earn a potentially higher return compared to putting the money in a bank account. So for example, if I were to look at cash management account that put their money into money market funds, so this will effectively be funds that are managed by fund management companies and aim to be earning a higher return compared to their benchmark, which can sometimes be the bank savings account return. So one popular money market fund is the Fullerton SGD Cash Fund. And what we see here is that for the Fullerton SGD Cash Fund, it actually has a 7-day annualized yield of 2.6% as of 13 June 2025. So this is actually higher than what I have seen earlier and discussed about the T-bill yield and what we have seen for the fixed deposit rates as well. However, it is worth noting that compared to the T-bill, which is issued by the Singapore government, or compared to the savings account or fixed deposit rate, which is SDIC insured, these funds are not capital guaranteed as they are an investment product, and all investment products carry risk. So before you actually put your money into any of this cash management account or money market funds, do spend some time to understand what they actually are. And once again, on the Beansprout website, we share more details about these money market funds for you to understand them better. The other advantage of the money market funds is that they allow your money to be withdrawn at short notice. So effectively, that is something that investors may prefer if they want better liquidity compared to fixed deposits. If you're interested in the cash management accounts, do look out for the promotions that may be run by the different platforms. So for example, for this month, we see that 𝗖𝗵 is running a promotion offering 4.1% per annum fixed returns for 90 days on the first 20,000 invested in Cash Plus Flexi. This is a promotion that is only for new users to 𝗖𝗵, and this is actually above the projected return of 2.8% to 2.9% per annum on the 𝗖𝗵 Cash Plus Flexi. So while this headline return may appear attractive, I would always still understand what the underlying investment product is. What is 𝗖𝗵 Cash Plus Flexi? What are the different funds that it actually invests in? Because once again, these cash management accounts are actually investment products. They are not capital guaranteed. And effectively, there is a risk that you may lose your capital when investing in them. Next, we also have some of the cash management accounts with guaranteed rates. So what we see here, we have got 𝗖𝗵 Cash Plus Guaranteed, which is offering a rate of 2.1% per annum for a 3-month duration as of 13th of June 2025. Okay, so this is actually lower than what we saw earlier for the best fixed deposit rate. And if I were to look at the statutory simple guaranteed, it is offering a 3-month rate of 2.1% per annum as of 13th of June 2025. And this is also below the best 3-month fixed deposit rate. Okay, so the options that I shared earlier were all Singapore dollar denominated options. For those of us who are actually based in Singapore, have most of our savings in Singapore dollar, and actually want to be retiring using Singapore dollars, then those are some of the different options that we can consider to be earning a higher yield on our savings. So some of us may also have US dollar denominated assets. So for example, we may have some savings that we want to be investing in the US stock market, but have yet to actually deploy them. So in that case, we can also think about what are some of the other options to earn a higher yield in US dollar terms. So starting from, say, fixed deposits, we see that the US dollar fixed deposit rates are generally higher than what we see for the Singapore dollar fixed deposit rates. For a 3-month tenure, I managed to find a fixed deposit rate that's at 4.3% per annum, and that is above what we saw for the Singapore dollar fixed deposit rates. So what is important to note about the USD fixed deposits is that they are not insured under the SDIC. So if having the peace of mind from having the SDIC protection is important, then that is something that you might want to take into consideration before putting your money into USD fixed deposit. Okay, apart from USD fixed deposits, we also have other instruments that are denominated in US dollars. So we have the US Treasuries, which are the US government bonds. And what we see here is that the US 1-year Treasury yield was at 4.16% as of the 10th of June. Okay, so this is quite similar to the Singapore Treasury bill, just that in this case, it is issued by the US government. So earlier I shared about Singapore dollar money market funds. There are US dollar money market funds as well. So you can actually go to the Beansprout website if you want to be understanding more about this USD money market funds. So I've shared quite a number of different instruments in today's session. I think the key question around how do we decide between the different places to park our cash really comes down to a few things that I will consider. The first is whether I'm comfortable with a product that is not SDIC insured or backed by the Singapore government. Okay, so if I want a product that is SDIC insured, then I'll be sticking to savings account as well as fixed deposit. Next is a question about liquidity. Would I need the money in short notice? So if liquidity is important, then maybe savings account is where I can have instant withdrawals. Next, some of you may actually want to lock in the yields for a longer period of time, and that is where the Singapore savings bond actually allow us to be able to lock in the interest rate for a period of up to 10 years and not have to worry about reinvestment risk. Okay, the other good thing that I shared earlier about the Singapore savings bond is that they allow us to have the flexibility to redeem anytime. Last but not least is a question around whether there's any use of the cash in US dollars. If most of your savings is in Singapore dollars, most of your retirement assets is also in Singapore dollars, then there may not be a need to actually look at US dollar denominated products. That is because when we actually invest in US dollar denominated products, we have to think about the currency risk as well. So from a rate of 1.37 at the start of the year, the US dollar has actually depreciated to now about 1.28 versus the Sing dollar as of 13 June 2025. Okay, so what this means is that if you have your assets actually in US dollar and you then want to then change it back to Singapore dollar, you may actually incur a currency loss, which may actually offset what you are earning in terms of the higher yield at this point in time. Okay, so I've actually shared quite a bit in today's video, and I just wanted to finish up by doing a quick recap. First and foremost, we started by looking at the T-bill yield, where currently it has actually fallen to a cutoff yield of 2.05% in the most recent auction. So for investors who are looking at a yield that's above 2.05%, we have looked at a few different options, including fixed deposit rate, where we see that the best 6-month fixed deposit rate is at 2.35% per annum. The best 12-month fixed deposit rate is at 2.45% per annum, but these are only for deposits below 20,000. Okay, next we looked at savings accounts and we talked about the UB Stash account that actually allows you to earn a decent interest rate without having to jump through many hoops. What is important to note is that from 1st of July, the interest rate from the UB Stash account will be cut to 2.045% for $100,000 of deposits. But with the UOB Cash is King promo, we can actually stack our rewards such that effectively we are still able to get an interest rate that's above the 2.045% per annum level. If you prefer something that doesn't require you to jump through hoops, we have got the JXS savings account, which offers a 2.08% per annum rate for a 1-month or 3-month maturity period. We also have the 𝗲 Cash Plus Guaranteed, which is at 2.1% per annum for a 3-month term. But these are actually below the rates that we saw for the best fixed deposit rate for a 3-month term. Next, I talked about the money market funds and cash management accounts, and we discussed different promotions that the platforms may run from time to time. And for this month, what we see is that 𝗲 is running a promotion for the Cash Plus Flexi Cash Management account, where new users can get 4.1% per annum fixed returns for 90 days on the first $20,000 that's invested. Okay, but what's important to note about the cash management account is that they are not capital guaranteed and they are also not SDIC insured. So if you want to learn more about the different products that I shared, whether is it savings account, fixed deposit, T-bill, Singapore savings bond, or the cash management accounts, do visit the Beansprout website where we actually provide more details as well as the latest rates on the different places to park your cash to be able to earn a higher yield. If there's any product that you want us to go into more detail to share more about, do leave us a comment in the YouTube video as well. Thank you so much, and I hope to see you at our next video.